We just didn't have a lot growing up. We would go to the grocery store with like $74. And when you had the stuff on the conveyor belt, like anything past $74, we had to put it back. Everybody is like really jealous of Warren Buffett, right? Like, he makes more in Coca-Cola dividends than we're going to make in our lifetime, like in one quarter. The work that he did over the last 50 years that nobody notices. It's when Warren Buffett got his first $200 from Coca-Cola, nobody was like, man, look at Warren Buffett really got his things figured out. Nobody thought that. The life cycle of a dividend investor. And it was like, you get your first penny and everyone's like, okay, cool, a penny. You get your first, dollar. And it was like, oh, congratulations, $1. Like, whatever. Good luck. Don't spend it all in one spot. You get your first $10. You get your first $100. Nobody cares. But then once you start getting like $1,000 a month, people are like, wait a minute. I think the thing that we need to do as a dividend community is make dividend growth rate cool. I'm going to get to the point where the portfolio is putting in more money to the portfolio than the wife and I are putting into the portfolio. So that's just like a whole nother couple working for my portfolio. My recommendation, not financial advice, is a 6-foot ladder with no steps is a pointless ladder. So I can set a 6-foot goal. That's fantastic. But I need a step every 12 inches to make that ladder even useful. It's not about this year. Like, I want to be, when I look at the Fidelity thing and it says 10 years or lifetime, that's where I want to be outperforming the market.
Investors, welcome back to another go-round of Masters of the Market. Now this week, incredibly excited to have on with me Troy Marsh, who's over at the Dividend Obsession. So a fellow YouTuber and a fellow dividend investor here to talk all about dividends. Troy, I want to welcome you first and foremost to Masters of the Market. Great to have you here. And I'll just kick over the first question to you. What exactly is your story? How'd you get to where you are today and how'd you get started there?
Yeah. So first of all, Ari, thanks for having me. Thanks for dealing with all my technical difficulties. So my starting story in investing is kind of weird. So dating all the way back to 2017, I remember opening a Robinhood account. I think I saw a commercial for it. And I remember looking up like Apple or Nike or something of the like. And I think it was like $110 or something like that. And I clicked on the stock, and then it came to the point where I had to fund my account because I had no monies in the account. And that's where it got really like nerve wracking for me. I was kind of scared about that. And then I ended up closing the app because I'm the type of person, and maybe your viewers can relate. I'm more afraid to lose money than I am excited to make money. Now, get me wrong. I'm very excited to make money, but that shows you how afraid I am to lose money too. So it goes back to your risk tolerance and stuff like that. That was 2017. 2020 comes around, all the talk about finance and stimulus checks and all these things. So I remember watching, I think it was Andre's channel, who's very big in our space. And I think he had like a Robinhood link, or it might have been Graham, one of the two. And I clicked on the link. I got a free stock. My free stock was Sirius XM, which if anybody was around, in the early 2000s, everybody had Sirius XM. It was satellite radio, no commercials, all the things, right? So they actually pay a dividend. I didn't know this. I didn't know what a dividend was. I just remember getting one free share of Sirius XM. I think it was like $2 or $4 or something. You did your little scratcher, got Sirius XM, boom, confetti, all the things. And I remember it was in like May. I remember getting an alert on my phone from Robinhood, and it said, congratulations, SiriusXM has paid you 1 penny in dividends. And before my excitement kicked in, I had the question of what is a dividend and who do I owe this to? Like, do I need to put this away for something? Like, what goes on with dividends? Like, whose dividend? Like, I didn't know anything about it. So it's kind of weird to fast forward into now where I have a whole channel with a couple thousand subscribers talking about dividends, and literally I went from not knowing what investing was to being afraid to put money into an account to getting my first accidental dividend off of a free stock, to now talking about it for, a couple thousand people, which is pretty exciting. So
a lot of people, on the other hand, actually throw a lot of money into the market and lose it right away because they're, as everyone always knows, I say, trying to get rich by Tuesday. Mm-hmm. So they'll throw the money into some crazy meme stock or growth stock, whatever it may be, and they lose it. And then they become a little bit more fearful. For you, you didn't even start yet. So where was that risk tolerance level coming in for you at that point in time?
A lot of it's like due to upbringing. And I would assume that a lot of the other people's, their situations also due to upbringing, just maybe the opposite. So like me growing up was like, I lived with my dad primarily. I'd go see my mom on every other weekend and in the summertime for like 6 weeks when school let out. And my mom was she wasn't great with money, but she was a very hard worker. So she would work hard so she could spend her money. And my dad worked. He didn't like working as hard as my mom did. I don't know many people that like working as hard as my mom did, but like he was just like, we just didn't have a lot growing up. So it was one of those things where like it was almost like a hoarding thing. And like, some people hoard items. I was a hoarder of money growing up. And it wasn't like an investing thing. It was just like I had separate wallets at my mom's and dad's house for whatever reason that they wanted me to do that. And I remember for like Christmas and graduation and all kinds of stuff, anytime I'd get money, I just put it in my wallet and I would just have it. So as like a 13-year-old, I'd be walking around with like $400 in my wallet, like just not normal stuff. Think that's where that comes from, but don't get it like too twisted because I went through in the beginning of that before I am like grown into the dividend investor I am today. I was very similar to what you're talking about, where like the way I picked my dividend stocks was I went on Robinhood, I saw the biggest losers and winners from the previous day, and I just bought the biggest winner from the previous day because surely if it goes up yesterday, it's got to go up today, right? Like that's how the stock market works. So one of my first like holdings I actually bought was like ARTC or AR. It's some combination of those letters, and it's like Araceutics, something Holdings. And I remember I bought it, and like it was already like unhealthy relationship with the stock market because of my fear of losing that money. Where I was basically doing what people do with crypto, but with stocks. Where like I bought it, and I was like on there like 4 times an hour, just like, oh, look at me, I'm up 0.2%. Oh, no, 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 I'm gonna lose all my money. I'm down 0.3%. So I was like watching it like a hawk, and it was that part wasn't healthy, and I knew I had to pick like something different to like really make this more sustainable long term if that's what I wanted.
Where do you think that, we're going to say, mentality comes from for those of us who may be out there throwing a lot of money, haven't learned our lessons yet, and are trying to get rich by Tuesday? Because it just seems like so many people need to learn, I feel like, just the basics of Warren Buffett to understand like this is a long-term game, not just dividend investing.
Mhm.
Even if you're invested in growth stocks, this hype mentality of getting rich by tomorrow or Tuesday, where does this come from?
Especially now, I'm gonna say nowadays, like I'm old, but nowadays with like everything else seems to be like if you want it, you can get it immediately. Whether it's your groceries delivered to your door, whether it's you want to watch a whole thing on Netflix or whatever. Like when I was growing up, you had on demand on like Comcast and stuff, but like that was like the extent of it. It was just like, hey, if you want to watch Rugrats, it comes on Saturday mornings at 8:30. Like, be ready at Saturday mornings at
Yeah.
8:30. It was kind of, like we knew where you had to be at what time. But like now, if I want to watch Rugrats, I can go on YouTube and watch it. I think it's on like Paramount or something. Rugrats is
Sure.
on there. That's like my favorite cartoon growing up. I think a lot of things are that way. Like get rich by Tuesday, have it tomorrow. Like if I want pizza right now, I can get pizza. Now, pizza's a bad example because you could always get that. But like I remember growing up, I always was like, why doesn't McDonald's deliver? Like I can get Pizza Hut here in 15 minutes, but I have to go to McDonald's. I was like, that's ridiculous. I'm putting my foot down. That's ridiculous. So like I always wondered that. Now you can. Like if I want a McFlurry now, I can get one in 5 minutes to my house. So people think it's the same with investing. And I think another thing that's kind of crazy is I personally think that everybody's still afraid. Not like the people that are investing aren't afraid, but like the people that are just starting investing or afraid to start investing, they're all fearful. And the reason is, I think they're fearful because they know they're behind. And because people are
Mm.
behind, they do drastic measures, like whether it's a race, like in finance, or a race with a car. When it's the last lap on like NASCAR, it gets a little chaotic there because it's like, hey, this is all I got. It's my last chance. If I'm gonna get first, I gotta go now. And that's when a lot of wrecks, and there's a reason that the race doesn't end on a caution flag in NASCAR. Like they race, and then like, if there's a wreck, we got to restart. We got to do the last lap over. Like in life and investing, it's that way too. Where like everybody's like, oh, I'm 30, and then how many videos are there on the internet where they're like, how much your net worth should be by 30, and people watch that and they're like, oh, my net worth should be $78,000 or whatever it should be. I only have $40,000. How do I catch up as fast as possible? And I think that's kind of what it breeds into. One, you're like everything else in life is kind of that get rich by Tuesday, or you can have it when you want it. And people assume it's that way in dividend investing and, try to take the shortcuts. And, sometimes you get burnt. Sometimes, the other thing is it's social media. You hear a lot more about the success stories where it did work for that one guy that one time. And you hear about that. So you're like, oh, yeah, this is way more common than it is. And, you get burnt with that. So,
Sure. And it's all hyped up. Now, I actually love what you said about feeling behind,
mhm.
and then you go like full throttle, Hail Mary, I got to hit a big home run. And if I don't, I'm a total failure. Is there a way for all of us to combat those emotions or those feelings? Because the reality is, for anyone who gets started in investing, I feel like you're already a leg up on all those around
Mhm.
you because so many people, I mean, the masses just aren't invested, really.
Mhm. I mean, I think the best way is to like actually have a plan. And like you have to have a plan and plan, goals, and timeline are like the things that you need to have. And you could say plan and timeline are kind of the same thing, but like you need like what are your goals? So I say this all the time on my channel is like if your goal with a dividend portfolio is to just have enough money to like pay your grocery bill, like that's obviously way lower of a bar to clear than to be able to retire and live off of your dividends. Like those are big differences. Setting a clear goal from the beginning, and it's not a bad thing to have a goal that's lower and then achieve that and then move your bar up. I always say on the channel on my dividend discussion series that a 6 foot ladder with no steps is a pointless ladder. So I can set a 6 foot goal. That's fantastic. But I need a step every 12 inches to make that ladder even useful. So it's the same thing with dividend investing or investing in general. Like you have to have a big goal. And then I always set a base, a good, and a best case scenario with my goals where I'm like, hey, I would be happy if I achieved the base case. Like this is what I'm kind of expecting. This is what I'm shooting for, whatever. And then I set a little bit more, courageous, a little bit more adventurous to see if I can really push myself. And then I set one like, dude, I would be overjoyed if this thing happened this year or whatever it is. And like you can do them yearly, you can do them monthly, quarterly, whatever it is, but like having goals to work for and like really keep yourself like grounded in the moment and like realize that like there's always a quicker way to do something, but it doesn't mean it's the better thing to do.
How many times have you gotten the comments on your channel, why not just go all growth because dividend investing is so slow? And for those who have commented that on your channel, what's been your reply or what's your take on that?
So I have two things. One's directly answering your question. The other one's kind of answering your question. So the one that kind of answers your question, I actually one of my better performing videos on the channel is the yield max stuff. Like I did a review and it wasn't to bash. It was quite literally, I'm hearing about this. I want to know about this. Like I don't know anything about it. I'm hearing about it a ton. So I was looking at it and the simple question I was asking, okay, would you rather own TSLY or Tesla? Would you rather own Apple or APLY or whatever the combinations are? Like what the thing it tracks or the actual thing? And even in the case of Tesla, where Tesla doesn't pay a dividend, Tesla still outperforms TSLY that pays like a 60% dividend. So like I just had a commenter the other day comment on my thing and he goes, yeah, something along the lines of like, but I can own a lot of shares of TSLY, therefore getting quote unquote a lot of dividends. And I was like, yes, you can also own a lot of dog turds and it's still not worth a piece of gold. Like it doesn't matter. And I think that's one of the things that crypto really it like amplified is people start buying like Shiba Inu and all these tokens that are worth like fractions of pennies, and they can still spend the same $100 and get a bajillion of them, or they can spend $100 and get like a fraction of a Bitcoin. And it's the same thing with like if you have $100 to invest, you can get what, a share and a half of Coca-Cola, or you can get a laughable amount of Berkshire Hathaway. Like what should people were like, oh, I'd rather have Coca-Cola. I'm like, well, is Coca-Cola actually better than Berkshire Hathaway? Like you have to actually like sit down and do that. So that's kind of like one of the, what was your direct, I had a direct answer to one of your questions too. What was that?
Why not go like all in on
Hmm.
growth? Because this dividend game, it's just going to take, I mean, some people think forever, but
Yeah.
so others just don't even think it can be done.
No, so my personal answer to that is I am doing I think there's a gray area in the middle called dividend growth investing, which is what I partake in, where it's not all dividends and it's not all growth. It's a combination of the two. So think your Apples, your Visas, your Microsoft, stuff like that. They pay a dividend. The dividend keeps growing. They also have really good capital appreciation. So therefore it's the total return. And the idea, my strategy is kind of twofold, right? If I can get my Apples, my Microsofts, my Visas, those kind of companies to have a yield on cost that's high enough to support what I need to do when the time comes. My goal is at 50 to retire early. If I can hold those companies and they can do that for me, fantastic. If they can't, and I'm hell bent on my goal at 50 years old, I can then sell at long-term capital gains and I can transition that into even at something less risky but more stable of like SCHD, where instead of getting my 0.5 dividend yield that I'm getting from Apple, I can get like a 3.5 or 4% yield from SCHD, which stretches my dollar further. And it's, arguably just as safe. So that's kind of my strategy. And I'm like, I feel like the people that are anti-dividends that say that, like, oh, go all growth, whatever, that's cool, but they have no option but to sell. Like the selling is the only way they get their money out, and they are 100% at mercy of the market. And I don't like that. I don't like the thing of like, oh, Netflix is great now, but Netflix wasn't great, 18 months ago? Netflix was in the toilet. And what if you needed to retire when Netflix was in the toilet? Like, now what? And then you're just like, okay, I'm going to wait until it comes back. But that's assuming it does come back. What if it doesn't? Like people always pretend they know that like this thing's going to happen next. Like that's not how investing works. Like everybody pretends. CNBC will have you thinking, every guy that comes on there, every girl that comes on there is, Nostradamus or something, but that's not how it works. So we are just guess, and the market does what the market does, kind of things.
Troy, can we go back to that first moment that you decided, like, I'm going with dividends? I'm going to be investing into dividend growth stocks. Was that the mentality that you carried then, or is that only now the mentality that's kind of come to be just from your experience?
Yeah, I mean, I think it was just the fact that I accidentally made a penny. Like the completely passive part of it is just like one, it's I'm investing in stocks that I'm hoping will appreciate in capital. That's first and foremost. I don't want to buy a stock and just like because I'm getting an 8% dividend, that's nice, but like I'm either stable or losing value in my original investment. That doesn't make any sense to me. So like my initial thing is I want this thing to outperform. Like I want it to do very well. It just also happens to pay a dividend. Like that's kind of the requirement. I don't want to just invest in something that's going to do well or I think is going to do well and not have a dividend, because that's how we get into the trap I was just talking about. So like that was kind of what it was. I was just like, I stumbled across SiriusXM. It was a free stock. I got this. I didn't even know I was getting it. I didn't know what it was. I just know that I didn't do anything for it. So like the idea is if I want to get to a point where I can retire early, which I don't know, in the US, early, like regular retirement is like 65 or something like that. So I want to retire 15 years early. I need to figure out a way that I can make money. And I'm a part of the camp of doing the least amount of work to get the most results. It doesn't make sense to give 110% if I'm only going to get 100%. If I can give 80% and get 100%, why would I give 110%? It doesn't, like, that extra 30% is being wasted. I'm getting the same results regardless. So it's one of those things where if I can buy these companies where I'm putting more money in them, they're growing that money and they're giving me a dividend that's also growing at a double-digit rate, which is the kind of companies I invest in. It's almost at this point, my snowball in my portfolio is starting to like actually pick up some steam. And it's almost like the wife and I are contributing towards the same portfolio. At first it was just me, then we combined finances. Now it's me and her. And now it's almost like there's a random third person just throwing in some money every once in a while. And like that's how you do it. Like I was just talking to my cousin the other day about it. Like this year I'm on pace to make, I don't know, somewhere between $1,700 and $2,000 in dividends. This is, I think, year 5 or year 5 for me. And it's basically been doubling at least every year. So about 17 to 2,000 what I'm making this year. That's $1,700 to $2,000 that I didn't put in the account. It's putting in for me. And then next year, say I make 3,400 to 4,000, that's going to be $4,000 that my portfolio is putting in for me. And eventually I'm going to get to the point where the portfolio is putting in more money to the portfolio than the wife and I are putting into the portfolio. So that's just like a whole nother couple working for my portfolio. So that's really what I like. It's passive. It's going to keep growing. It's going to grow faster than inflation. And worst case scenario, I can sell this big nest egg and then divvy it out just into ETFs if I want to live at 50 and just be like completely hands off. I don't want to look at extra stocks or nothing. Just put it in VOO, your QQQM, your SCHD, whatever. Have my nice 3.5% on extra money that I didn't invest because it grew, and then you're good to go.
Let's jump in a little bit to this portfolio of yours. So it's been, if I heard you correctly, about 4 years you're investing into this portfolio, dividend stocks. Right now, the total value of your portfolio, and you can ballpark it. Where do we stand?
So I think the total value of my portfolio, like invested, is something like 57,000.
Okay.
The reason I say invested is because I keep my emergency fund in my portfolio, which I've heard takes a lot of discipline. I don't even have like an inkling to spend it. Right now with my Fidelity account, SPAXX, which is just a cash position in there, is getting, I think, like 4.97% interest or something. So the wife and I have 1 month's worth of expenses in our checking account that we keep in there at all times. And then obviously we spend money out of there. It's a checking account. And then we have 5 months worth of expenses in this cash position, which in our case is $17,000. I think that puts us at like $3,400 a month in expenses. So if, something hits the fan, we both lose our jobs, we can sustain our current way of living for 6 months off of this money. That's the point of an emergency fund. But in the meantime, that 17K is getting me about $70-ish for free every month. And anything over 17K, including what we put in at the beginning of every month, is all investable. So anything I see past 17K, so once the comma hits, anything more than that I'm able to spend that or invest that. So that's kind of really what that takes my portfolio up to like 70 something thousand, do the math, whatever, 57 plus 17. So, I mean, that's why I have to say invested, but that's where I'm at. And that's just in that account. I do have a Roth IRA that I did a 401k rollover with when I left my last company. That thing's sitting at like 70 something thousand too. So I think all in, I'm close to 150 between those two accounts at least. So
Okay. And the plan, as we all know, is to hit retirement by age 50. So break down your portfolio for us. And I've been getting a lot of comments. People want to know what's in your portfolio, like stock by stock. So you can give us like, I will go with like the top 10 holdings that you got in there, the ETFs, the big names, but break down that portfolio for us in case anybody else out there wants to follow you and your dividend journey.
Yeah. So in my in my IBA, my retire early account, I call it, that only has 11 holdings in it. I want less, but at the same time I want more. Like, I have other companies that I wish I could trade it out for, but again, as we were talking before the interview, like, it's kind of one of those things that I believed in these stocks at one point. I have to give it a little bit of a runway to like let it see if it, like, just because Starbucks is one of my holdings, just because Starbucks is doing poor now doesn't mean Starbucks is a poor investment for 10 years from now. So, like, do I look at it now and all the turmoil, and I think I'm down a little bit in Starbucks right now. So, like, do I sell it and then put that money towards something that I think is better, but like that's better for now? Like, in 3 years, Starbucks could be booming, and then I think that's a bad decision. So I'm kind of balancing it with that. But anyway, so right now I have Apple, AbbVie, APD, Costco, Illinois Toolworks, Microsoft, NextEra Energy, Pool Corp, which I never hear anybody talk about. I love that stock. It's very volatile for whatever reason, but I think all the metrics on that stock are great. Starbucks, Visa, and ExxonMobil. That rounds out my retire early account. In my Roth IRA, that's the one where I only do ETFs because I have a lot to manage with the other portfolio. And truthfully, one of the main reasons I'm actually doing individual holdings in that portfolio I just discussed is for the channel, because it would be very boring if I was just sitting here like, bought more VOO today, guys. Like, come back next month. Like that doesn't do anything for you guys. So, like, I try to mix it up, and I have to have stocks that, like, it follows my criteria. It does all these things. So with that being said, my Roth IRA, I don't also have time to manage a whole separate thing there. So that is QQQM, which is basically NASDAQ 100. I have SCHD, SPYG. Only individual holding I have in there is Tesla. I really like Tesla. If it's going to grow, I want it to grow in an account that's tax advantage. So Tesla's in there. UPRO is a new holding I just started this year. I don't know how many people watching, or if you know about it or have heard about it. It's a triple leveraged S&P 500 fund. I have a hard time understanding why people hate on it as much as they do. So far I have it in my Roth. It's up, I don't know, 40 something percent. I just bought it January 3rd. I also have it in my HSA, and I have TQQ in my HSA, but which is the triple leverage version of the NASDAQ. Both of those are killing it. And my goal, if I lose it in my HSA, that's just play money anyway. I don't go to the doctor. So, like, it's, if I lose 6K, I lost 6K. Who cares? But and it's tax advantage in there too. So if it blows up, cool. I made a lot of money and it's tax free. So yeah, UPRO in here. VNQ is my real estate exposure. I don't have any REITs. They're not tax advantage. If you hold them in your Roth, they are tax advantaged, or they're tax sheltered, I should say. But I couldn't pick a REIT, and I own a house, so that's my exposure to real estate. So I didn't feel the need to own like Vici and Realty Income and all those. And then I own VOO. Now with that breakdown, I have not 10% of all those other companies. So your QQQ, your SCHD, your SPYG, Tesla, UPRO, and VNQ, all 10%. That makes up 60%. VOO is 40%. So, like, I have a majority, like a big piece of that portfolio is in like smooth and stable VOO. Like, everything else is kind of like doing what it wants. And then VOO is like the staple of that. So, I mean, that's kind of what I do with that. And then with my other portfolio, the first one I was talking about, I mean, the goal is my highest conviction ones. I want to get those to 12%, which in this case is Costco, Microsoft, Pool Corp, and Visa. Those are my favorites. Like, they meet my requirements the most. They're the ones doing the best for me. Everything else is either 11 or 10%. I know you're not supposed to go over 5. I only have 11 holdings, so the math doesn't math there. So I need to have over 5%. So yeah, that's my long-winded answer to your question.
So we'll go back to, actually, I want to ask this question here. Before you started to invest, a lot of people would say, "Oh, I'm going to throw all my money into individual stocks." Other people say go ETFs. Where were you? Did you start with ETFs? Like, did you start with VOO? Because you said, I'm doing a lot of the individual stocks for YouTube. would you recommend to start with just this plain simple ETF, VOO, S&P 500 type of fund? Or would you recommend actually trying to go in on like 10, 11 stocks?
Where I first started was, I don't want to say where I first started, but like once I actually like felt like I knew what I was talking about, slightly before I started the channel, I at one point had 39 holdings in my individual account. 36 of them were individual stocks, 3 of them were ETFs. The issue and what led me to the portfolio where I am today is I had so little money, as anyone does when they first start a portfolio. I'm not sure how many things I actually had full shares of. Like I had like $3,000 in there spread amongst 39 holdings. Like it was chaos at this point. Like literally, like the pie chart would look like you're getting hypnotized, is what it would look like. It was rough. So like it was one I don't recommend that. My recommendation, not financial advice, is I think anybody that's starting, it depends on like how gung ho you are. Like if you're just like, hey, so and so convinced me that I need to be investing, and like that's the extent of like your excitement for it, there's one piece of advice. And if you're like, hey, I'm convinced I need to start investing, this I'm super like you're all into it, like you really enjoy it, there's a different piece of the recommendation. I'm going to assume that the regular person I'm talking to is they just know that investing is a thing that they need to do, and they want to make sure that they have more money later than they have now, which that I feel like encompasses most people. In that case, my suggestion, or if I was doing it all over, I would try to get 10K into like 1 to 2 ETFs. Like it could be combined, it could be total, it could be individually, it doesn't matter. Like if you wanted to do VOO and QQQM, just like get 10K, like 5K, 5K, you can do 10K and 10K, whatever. I think what that does, and I've recommended this on my channel too, I think what that does is it gives you time. It gives you time that you're going to have to, put in the time to actually accumulate 10 or $20,000. And by the time you do that, you figure out what you are. You figure out if this is all you need in life, if you're cool with, hey, I'm seeing the progress, I'm seeing the discipline, I'm seeing this, I'm seeing the returns, I'm seeing the dividends. Both of those both pay dividends. So it's not like you're not getting the dividends. It is a dividend channel. They do pay dividends. So you can do that. But if you get a little bit more curious, you're like, oh, I'm getting a dividend. Like, what's a dividend? You can start to do that. You can start to go down the rabbit hole, all while building a solid base and actually make it to where your portfolio can stand on its own. Like if something hits the fan or whatever, it's more sustainable to have ETFs than individual holdings. You have to monitor a lot less. So that's what I would do. It's 10K, either combined or individually into an ETF to start. And then you can be like, okay, VOO is doing really well for me. Like, I wonder what makes up VOO. Like, what are the top holdings in VOO? And then you can start breaking it down into there. Like, oh, like, what do I like? I like things a little bit higher yielding. Oh, I like a lot more dividend growth or whatever it is. And you can really break it down from that point. And that's how if I was starting all over, that's what I'm doing for my kid's portfolio. He's, 1.5. He has his own little portfolio, QQQM, VOO, and we're just going to build it until he starts to get an interest. And if he starts to get an interest, we'll start like sitting down like, oh, what are they talking about at school? Like, what are good companies? Like, what's everybody wearing? Stuff like that. Then you can go down like, okay, let's look at the fundamentals of this company. And like, I don't dive super deep into that stuff, but like, let's look at it at a surface level and see if it's worth it. And if you want to put, $10 from your $100 investment that we're about to make into that, let's do that. But he's going to have that base of the ETS first. So
now you went from 39 holdings down to now the 11 that you have. At one point, and it was back in 2020 for me, everything was on a major discount. I bought a lot of stocks, and I think I surpassed you. I think it was at like 40 something holdings. And then I watched this Bill Ackman interview where Bill Ackman said at any given time, there's really only a handful of like high quality, exceptional investments. So just try to find those investments. That made a lot of sense to me. And that's when I pivoted and started trimming my portfolio. I'm curious to know, why did you pivot? What made you come down to 11 holdings? And how did you get down to that number?
the number of 11, there's literally no rhyme and reason to it. It would just kind of like keep trimming until I felt whatever. The reason behind the trimming was, one, it felt overwhelming to have a lot of holdings. And like I said, I'm not even like a know who the CEO is, like dig into all the numbers. Cause like I get informational paralysis where like every time I learn a number, I discover there's another number I didn't know about. And like I have to reevaluate all my other stuff to that new number I just learned. And like it just gets crazy. So like I had to set filters and criteria for my stocks. And if you meet that, you're on the list. But like I have a bunch of stocks that qualify to meet my portfolio, but I don't want to add another position right now because I'm trying to build. I hear people talk about like full positions all the time. I have no idea what that means, but I know I don't have what I consider a full position. I think like right now my highest like amount invested position is Microsoft at $5,200. So like that's it. Like I say that's it. Like that's a decent amount of money, but like I want to get that to more. And then like, do I want to get all of them to like 10,000 before I consider adding another one? Like when do I put in a sell? Do I ever sell again? Do I just like right now, my 11 positions, I have 2 of them in dormant status, which is something I tried this year. And that's basically saying they didn't meet one of my most important criteria. So they're basically on punishment. I'm not adding any more money to them. They can reinvest into themselves, but I'm adding into the rest of my positions that are behaving themselves. What do I do next year if those same positions are now 2 years in a row? They're not meeting my criteria. Do I consider a sell then? Like that's something I'm working through, and that's one thing I like tracking on the channel is like I'm going to talk about that, and if somebody convinces me one way or another, or like I just you guys will get my my candid responses to whatever I'm doing kind of thing. So yeah, the 11 rant, I didn't pick 11. 11 just what it is. And then it was just overwhelming. And I knew basically I was spread too thin. Like I said, it was just like I didn't even have whole shares of many companies, if any companies. It was just like, oh, you have 0.24873 shares of Sherman-Williams and you have half a share of Coca-Cola. And it was just like so much to like try to keep. Now it was really cool when they would pay dividends because I felt like I was getting a dividend every day because like something was paying something. So that was the cool part. But like the grand scheme of thing, it was like there's a saying out there that like you would rather have a moat that's an inch wide and a mile deep than a mile wide and an inch deep. And that's kind of like my first portfolio was a mile wide and an inch deep. Like it couldn't fit anything in it, but it grabbed everything. But then this one is more of like an inch wide and a mile deep. Like it's not too diverse. I mean, it is diversified. It's really diversified, but like it also is just like concentrated in these things that I feel like I know well. So
you mentioned actually something about criteria, right? So what makes it into your portfolio? And you have a lot of stocks on the watch list, but not necessarily making it in. I'd love to ask you when you decide a stock actually makes it in, and what's the criteria? What's your process for adding stocks to your watch list and then adding them actually into your portfolio?
When it makes it in, I don't know. That's kind of one of the things I'm battling right now where I'm just trying like right now I'm just like, hey, I want to commit to the stocks I have. I picked them for a reason. I don't need to be, oh, look, a squirrel over there, look, a bird over there. Like, I just need to focus on the stocks I picked for a reason. Like, I picked them. They met my criteria at one point for a reason. So I need to, like, really double down on that. And as far as, like, my criteria is super simple, and it's in this order of importance. Outperformance of the S&P 500 over the past handful, I like 10 plus years. 10 years is, like, my thing. The idea behind that is if I'm going to take time to invest in these individual stocks, why would I want to underperform the market? Like I could literally spend half the time just throwing my paycheck into the S&P 500 and never worry about it. If I'm going to take the time to buy these individual stocks, I want them to at least give me more money. So it's going to be hit or miss. Like I don't like people that say, "Oh, I beat the market this month." Like I talk about that on my channel, and I'm underperforming this year so far, but it's not about this year. Like I want to be when I look at the Fidelity thing and it says 10 years or lifetime, that's where I want to be outperforming the market. Like it's not oh cool, market outperformed me this month or over the last 3 months I'm outperforming the market. I don't care about that. Like grand scheme of thing, it's big picture. Like I want to overall, would my money have been better doing less work or would have been better doing my portfolio? So we'll see. And as far as like the watch list, when I say watch list, I know people that literally have like a Seeking Alpha page. I think Ryan does this, where he has like a Seeking Alpha page and he has like an actual watch list. My watch list is quite. Oh, I never even finished my portfolio. So my criteria. Sorry, I'm all over the place. See, that's why I don't do the bird thing because I'm like that in real life. So my criteria. So outperformance of the S&P 500 over the past at least 5 years, 10 years is my goal. Second most important is a dividend. What? Yeah, the dividend growth rate. I like a 3, 5, 10-year dividend growth rate above 10%. That's like because I want it to not only outperform inflation, but I love. There's nothing better than when a random the company that you own just gives you a 14% raise for doing nothing. Like that's I'm going to make 14% more on this company than I made last year if I don't add another dollar. Like that's ridiculous. That's how you get your dividends to compound as fast as mine are, because not only am I adding money constantly every day, but I'm also they're adding more money than they were last time. So it's kind of one of those things. So that's 3, 5, 10-year dividend growth rate above 10%. And then my last one is a dividend streak of at least 5 years. I think weirdly, because of this whole COVID situation, we're in a very unique period where if you can have a company that's paid for at least 5 years, that kind of encompasses everything you need to know. It's before COVID's covered, during COVID's covered, during the great comeback after COVID is covered, during the 19% sell off in 2023 is covered. That was 2022, during the really good returns in 2023, during the seemingly really good returns so far this year. Like, there's been so much stuff going on with the market that these companies have not only proven that they can continue to pay their dividend, but they can pay it and grow it. And to me, that's the sign of a good company, because like they aren't like waiting on the next thing to drop, and they're reactionary to those things. Like they have a plan, and they're executing the plan, kind of thing. Going back to the watch list, like I don't have one, because all I have to do is add those filters. And then what I do is, like, whenever the time comes where when I am ready to add my next stock, whenever that is, I can literally just filter my stocks that there are in the market. And it's just literally like, okay, there's 2,200 stocks that pay a dividend. Cool. How many of them done it for the last 5 years? Oh, now there's only 200 stocks that have done that. And it's like filtering it down. And then at that point, it's like, okay, do I have a certain sector I'm looking for? Do I have a certain, whatever? What do I like? Sometimes right now, January, April, whatever, the 1, 4, 7, 10 months, whatever those are, that's my lowest paying month. I only have one stock that pays in that month. So I don't look at that. That's not a thing. But if it's like, okay, I have 3 stocks that are like in the running for like, hey, I'm going to add one of these to my portfolio. If I all feel evenly about all 3 of them, I might look at whichever one pays for January, because that's like the month I'm trying to get increased a little bit. So, but yeah, no real watch list. Just like whenever the time comes, I'll add my filters to it and see who comes out on top.
A lot of people are interested in monthly paying dividend stocks, and those very same people typically tend to say it's better to have monthly paying stocks versus, I don't know, 1 month or a couple months of not being paid a dividend because you're invested in quarterly payers. What's your take on it? Do monthly payers matter?
Monthly paying dividend stocks is kind of like, I mean, anybody that watches your channel is probably into like finance in general. It's similar to the dividend snowball versus dividend avalanche method. Like, there's a difference, but at the end of the day, they both get to the same place. Somebody could argue that a month, say Realty Income, it's like the most popular monthly paying stock. Somebody could they could argue that by getting Realty Income's dividend monthly, it helps them to get more money into it quicker, thus causing it to, compound on itself better or faster. But that's assuming that the market conditions are right for compounding. Because if the stock just keeps going up, now you're averaging up in your cost basis more frequently than I am. And I'm only doing it one time with more money. So I don't know. Would you rather get $10 a month, or would you rather get $30 a quarter? Like, to me, the only reason I even brought up like the whole January like payment thing is like just because it's cooler to talk about it on my videos, where it's like, okay, instead of saying I got $12, now I have 2 stocks that paid, and I can make my videos a little longer or something. But I personally don't think it matters. I think if you are disciplined with money, which if you get to the point where like living off of dividends is your goal, I feel like that's kind of a requirement. If you get 6K in December, which like that's typically like everybody's highest paying month is like December. If you get 6K in December and you only need $2,000 to live off of, and you're only going to get $1,000 in January, put some money back. It's not like put $1,000 back from December stuff, invest the difference. Now you have enough to cover for January. It's not that difficult. I don't know. It's just budgeting to me. I don't know.
Talk to us about dividend yields. Have you fallen ever into the yield trap situation?
Yeah, I think I don't want to call people liars. I find it hard to believe that anybody hasn't fallen into the trap. I just feel like it's a thing that we do. As soon as you learn about a dividend, the next question is, like, what do I put my money in to get the most money back? It's a return thing. Like, I do the same thing with my stock returns. If I can invest in Coca-Cola and get an 8 or like a 6% return year over year, or I can invest in Visa and get a 10% return year over year, why would I not put it in Visa? People ask themselves the same questions about Coke or about the yield. They're like, if I can put $100 into Apple and get $5 back, or if I can put $100 into TSLY and get $60 back, why would I put money into Apple? But it's a bigger picture thing. So to answer your question, I did fall into it. I was telling you before we started recording, at one point before I knew what dividend yield was, I backwards calculated dividend yield. I had a whole spreadsheet. It was real fancy, but like literally it was asking the question, if I were to put $100 into all these stocks that I identified, which one would give me the most pennies back? And it was like stocks like AT&T, Walgreens Boots Alliance, like those guys were Verizon. Those guys were always at the top. Ironically enough, I think those are some of the lower quality stocks out there. And I think there's a time and a place for yield. Like I was just talking about, like, if I have to ever position or transition out of my portfolio, I'd put it in higher yieldings, but I wouldn't put it in something that like the yield. I'm not a fan of the yield max stuff. I don't know if you can tell, but like I think it's crazy that people will put something in something that's super high yielding just to have like though you give them $100 and they give you 75. Like I don't understand that. Like you gave them more money than they're giving you back, and then you're losing your original money. And I don't know if this is a question you've ever asked, but like I hear a lot more people asking about it's referred to as the dividend avalanche method. Have you ever heard of that?
I have.
I don't understand. That doesn't make any sense to me because for your viewers, for anybody that's watching that doesn't know, dividend avalanche is like investing into a TSLY, a yield max fund, a really high yield, taking the returns from that and putting it into something that you would consider yourself higher quality. My question is, when is it ever a good idea to invest in low quality before high quality? And second of all, if that works, you're taking your dividends from a low quality investment while your capital is disappearing right before your eyes. You're taking those dividends and putting it into something that's higher quality. Therefore, the chance of that now being worth more money than it was had you just put that money there in the first place is probably higher. So you're paying a greater price than you would have paid had you not just put that original money in there, and your original money is losing value in the other thing. So like I don't understand that at all. I hear a lot of people just ask me about that, whether it's on the channel or just like in the spaces that we're in. And I just don't get it. So yeah, yield has a place. Be cautious with it. I did fall into the yield trap, and I think the thing that we need to do as a dividend community is make dividend growth rate cool. Like that's the thing. If people start focusing on dividend growth
MAGA
rate,
slogan.
yeah, exactly. Yeah, make dividend growth rate great again or something. I don't know. So yeah, it's that if everybody can focus on that, everybody's portfolio would do substantially better because companies don't grow their dividends, much less grow them by big numbers unless they're doing well.
I feel like we've lost touch with the Warren Buffett like investing mentality. As time is going on, maybe it's just because I wasn't invested 50 years ago and I didn't know how people were investing then. But this chase, like again, even within the dividend space, right? A dividend avalanche, as you're explaining it, and it's like, yeah, easily none of that makes sense. Why can't we just think long term, invest in high quality companies, and wait it out? Right? Like investing shouldn't really be that fun. I almost say like if you're gambling and having fun, you have to be very careful.
I want to do a follow-up video just to be petty of like the people that said I didn't get it. I'm like, oh, okay, that's crazy. They're like, oh, TSLY is the same price it was in your video. I'm like, yeah, little do you know they did a reverse split already to get to that number. Like they had to get back to that number is what they had to do. But so I think it just goes back to like the delayed gratification. Nobody's taught that anymore. Like it's just understand. And people are under the impression that whether you invest in high yield or low yield, high growth, like high dividend growth stocks, that the end goal is going to be the same and that there's not an option that they're different. Like they're under the impression that like if the end goal is to get the $50,000 a year in dividends and you're going to invest in these ones that take you 33 years to get there, and I'm going to invest in these ones that take me 11 years to get there, why would I do the one that takes longer? Well, I'm like, okay, what if I told you that the success rate of me getting there is 102%? It's like guaranteed I'm going to do it. And the success rate of you is like 20%. And that 20% is including you spending substantially more money to possibly get to the same place I'm going to get to. And like, that's what people don't understand. They assume that the goals are the same and it's the quickest way to get to the goal. Like, oh, I can clearly go this paved path and it's, or I can clearly cut through the grass and the finish line's right there. Of course, little do you know there's crocodiles in that lake. You didn't know about those, like all kinds of stuff. Like it's just, there's a chance it could work. Of course it could work. Like everybody that could be doing these yield max funds, call me an idiot in 10 years when you guys are all rich. Maybe, probably not, but I'm here for it. Like come on my channel, hit all my videos, call me an idiot on every comment. I'd love to hear that. I don't think it'll work though. So like, it's just one of those things. Like if you, I know a lot of people in this space where they want a piece of the yield max, they make it a point where it's no more than like 2% of their portfolio. I don't like that either, but I think it's better than the alternative of making it 100% of your portfolio. I just don't like it because a lot of those people. So another number that we all track as dividend investors is your PADI, your projected annual dividend income. The reason I said make the dividend growth rate cool again is because the PADI can be scary, because I think the PADI can lead you to being a yield chaser. Because what quicker way to make your PADI go up than to buy AT&T or Verizon or Walgreens or any of these higher yields. If you had $100, you're going to get 7% on that right away, right to your PADI. but like it's the total return that you have to consider. And I think that's what's lost. The total return, the dividend growth rate. Focus on those two things, you'll be all right.
Now you're also talking a lot about that long term, right? Delayed gratification. And in that comes the talk, I want to say, of frugality. And I want to know from you, because even you yourself, right now, you purchased a house, you and your wife,
Mhm.
you have a baby, you guys
Mhm.
are both investing in the stock market. You have this audacious goal to get there by 50, retire early by 50. A lot of that requires frugality. And I want to know from your standpoint, can we teach frugality, or how do we implement frugality in our life to actually get on the track to get to, I don't know, retire early if that's what someone wants to do, or even just retire comfortably?
So one slogan I like to always remember in my head is either the pain of discipline or the pain of regret. So I think if people just really think about that, like for us, and I was telling the wife, like I was really teaching her about like she knew what compound interest was, but I was really explaining it to her. Like everybody's seen the chart of Susie investing from 25 to 35, 10K. Like she never has to invest again. She has more money than Mike that did it from 35 to 65, like all those things. Like that is compound interest. And the earlier, the better kind of thing. So I was just telling the wife and like understanding that like it's you have to make those sacrifices in order to be like Warren Buffett. Everybody is like really jealous of Warren Buffett, right? Like he makes more in Coca-Cola dividends that we're going to make in our lifetime, like in 1/4 of Coca-Cola dividends. Like it's ridiculous, but like it's the work that he did over the last 50 years that nobody notices. It's when Warren Buffett got his first $200 from Coca-Cola. Nobody was like, man, look at Warren Buffett really got his things figured out. Nobody thought that. Everybody was just like, yeah, there's the good old. I mean, at one point, Warren Buffett was young. That's hard to believe, but Warren Buffett, young Warren Buffett over there, he's whatever, $200. Who cares? But like over time, like there's a chart I saw a long time. It was like a meme where it's like the life cycle of a dividend investor, and it was like you get your first penny, and everyone's like, okay, cool, a penny. You get your first, dollar, and it was like, oh, congratulations, a dollar, like whatever. What don't good luck, don't spend it all in one spot. You get your first $10, you get your first $100, nobody cares. But then once you start getting like $1,000 a month, people are like, wait a minute. Then you start getting $10,000 a month. People are like, wait, what are you doing? What are you doing? What are you doing? It just takes the time to let it work, and you have to let it go. You have to figure it out. Like again, it's the pain of discipline over the pain of regret. Like, would you rather go through, oh, I only went to one concert this year, I didn't go to 10 like all my friends, and like seeing it on social media, everybody posts like this highlight clip of their life and stuff like that, that's fine. But when your highlight clip at 50 to the rest of your life is literally endless, and they're worried about where, like, if they can get this at the grocery store or that at the grocery store, it's going to be worth it. And it's not even like a saying you're better than the next guy or the next girl, but it's quite literally like a lot of times people just, they don't understand wants and needs. Like it really comes down to as simple as that. Like just literally, yeah, it'd be great to go on 3 vacations a year. Who wouldn't love that? But would you rather never be able to go on? Like, would you rather cost yourself the ability to do that for the rest of your life, or would you rather be able to do that for the rest of your life and not even think about it? So I don't know. Long-winded answer to your question, but that's what I think.
Now, I know exactly what you mean by needs and wants, but I want you to double down on that. Explain a need and explain a want, and explain how the heck we differentiate between the two and actually choose the right answer on purchases.
Yeah, I think some people really make that like so set in stone. Like to me, my gym membership is a need. I feel like I don't subscribe to like a lot of the, not to say that mental stuff isn't real. I think it is. I just feel like some people they use it as an excuse to like not do anything. And like I think everybody has anxiety. Everybody has like moments where they're feeling sad and stuff like that. I think that stuff's true, but it's also everybody's got responsibilities and everybody's got stuff to do. So like for me, my gym membership is a way that I can stay fit, I can stay healthy. I can make sure that when my son is 18 years old, I'm still beating him up. And when my kid has a kid, I can still keep up with all of them and stuff like that. Like that's really what I want about that. And then like some people would consider that that's not a need. That's a want. Like you want to go to the gym. If you need to get physical activity, go outside and walk the dogs. Why do that also? But like, so I feel like you can't just say food, shelter, whatever, like clothing, like those. It's not, I don't think it's that simple. I do think it really breaks down to like, do you need 7 streaming services? Probably not. Like it's not a thing that you need. Do you need to spend $1,500 a month on groceries? People are like, oh, eating healthy is expensive. It's not. I get a tube of ground beef for $40 every week. I get a box of minute rice, a big box of minute rice for $4. I eat that 2 times a day, all 7 days of the week. Now, granted, I'm into fitness. Like that's kind of I just I eat for fuel, not for pleasure, kind of thing. So like that's fine for me. But I spend $44 a week on my food. That's less than most people spend that by Wednesday going out to lunch at work. So like it's one of those things. So it's not it's one of those things. It's easier to find the excuse than it is to find the solution. So I just really think what wants and needs are just really what are your today wants and needs? Are they the same as your future wants and needs? Because I think going back to delayed gratification, to me, my future wants and needs are better. Like they're more important to me. So like I might have to modify my today wants and needs to fit my future wants and needs. Because in the future, I don't want to look at something and think of the price. Like if I want this thing, I want to be in the position where I can get that thing. Now I might be like, oh, okay. Once I have to put it on my bank statement or whatever, I have to like figure out what I'm gonna do next. Not next, like figure out like if I can pay the light bill or anything, but like figure out like, hey, I might need to chill out for like impulse purchases for a month or two until I can do whatever. But like if I like right now, when I was growing up, going back to the very first thing you were asking about like my upbringing, when I was growing up, we would go to the grocery store with like $74. And when you were had the stuff on the conveyor belt, like anything past $74, we had to put it back. Like we couldn't get it. And like now I take pride in being able to go to the grocery store and like I might have weeks where I buy something that's I'm like, I wasn't planning on spending $111 this week, but like it is what it is. I don't ever put something back. And that's something that as I grew up, I was like, that's going to be something I never experienced as an adult. Like when I'm a family man and I have like a wife and kids, we're never going to have like, hey, we can't afford that, go put it back kind of situation. We're going to have like a, hey, this week we did like steak and beef. That's kind of expensive. Next week we might do like chicken, like as our chicken and tuna might be our meats for that week, just because we need to like recoup some of that cost or whatever. But like, I don't know. That's if that answers your question or not, but
No, it reminds me a lot of a recent read of the book Infinite Games. If you're familiar with that book, if you read it, it's all about the long-term thinking, right? Like even when it comes down to these needs and wants, to your point with a gym membership, some people would consider that a want, but actually, if you're going to the gym day in, day out and you're eating healthy, you're exercising, that is going to save you a heap of money in the future
Mhm.
versus you being overweight and having, I don't know, getting diabetes and one thing to the next thing, and you're paying all the money and doctor's appointments, copays, this and that. Troy, what do you think the biggest mistake that people are making today is when it comes to investing, or most common mistake?
I would say it's really not having a plan. Like they have no plan and they have no like timeline. Like people are listening to other people. Like I think it's great to listen to everybody and see what you can take out of whatever you can take. But I think that like for me, just because I'm 29, I think. Yeah, 29. So I'll be 30 this year in a couple months. But like my timeline doesn't line up with a 30-year-old because a 30-year-old wants to retire at 65. They have 35 years left. I don't have 35 years left. I have that'll be 20 years left if my goal is 50. So I need to be comparing myself and setting goals as if I was had 15 less years to invest. I mean, I'm granted when I get to 50, I'm not going to stop investing. It's just like that's my goal. That's when I want to be able to live off the portfolio. So I really think it's that like you need to understand your goals, your risk tolerance, and your timeline. Like you need to is this a vacation fund? Is your dividend going to fund your vacation every year? Or is it going to be what you're living off of? Is it going to pay your cell phone bill? Those are all vastly different goals. But like you need to understand that. And like I said, it's okay to change your goal. Like right now, I think I'm making a little bit over 100 120-ish a month off of my dividends. Like I remember when I first was making $10 a month and I thought that was cool and I'm like, oh, I can pay for a Netflix subscription or whatever. Now you can't pay for a Netflix subscription with that, but like it's one of those things where like that you can set initial goals and then move the bar, but like you have to have a plan. Like what's the plan? The plan is to invest for the long term. And I honestly think that's where people fall short is like they just have money and they know they're supposed to put it in the stock market. That is the goal and the plan. And I'm just like, okay, how long are you going to be investing? What are you like? Criteria on stocks is essential. I think no, the people that don't have that, you're not. I don't. If you're successful, it's an accident. Like I think if you don't have something that you can put your stocks through, whether you care about PE ratio, whether you care about dividend growth rates, whether you care about whatever it is, you need to have some filter to put your stuff through or you're like that's how you accumulate the turds in your portfolio. It's like, hey, everybody come in. Like I have $1 for you, dollar for you, dollar for you. Like especially now with fractional shares, you can literally own a piece of anything that you want. That's not like that can be a good thing and that can be a bad thing. So
To say the industry never stops creating ways for investors to, I think, get sidetracked
mhm,
from their own goals, or if they have
yeah.
goals, whatever the plan is for them. So with that in mind, how do you know? I mean, you're a YouTuber yourself. I'm a YouTuber. We're here day in and day out producing content for folks out there. How do you know who to trust?
It goes back to what I was saying before. Like, I feel like you can watch anything. I think the trust thing, like one of my bosses when I was first moved to Oklahoma, his saying was trust but verify. And I think that goes back to also having criteria. One of my series that I release is like 5 stocks you need to know about. It comes out every Friday on the channel at 8, like right before the market opens. So the market opens at 8:30 for me. It comes out at 8 o'clock, 30 minutes before the market opens. And the point of that series is to expose you to up to 5 different dividend stocks that I think are very interesting that you need to know about going into the following week. The idea of it isn't to say, hey, Troy talked about these stocks. I'm going to put my money in them. That's not what I want you to do. What I want you to do is say, hey, here's 5 stocks. Let me figure out what ideally you have your criteria before this, but let me add these 5 stocks to my criteria and see if any of them make it through. And if I'm really good and our criteria is on the same page or whatever, all 5 of them might make it through. If say our portfolios are completely different, you're into super yield, I'm not into super yield, none of them might make it through. And that's the point. It's just like, I want to give you a small place you can get stocks, put them through your own filters or your own criteria, and then you go from there. If you have like a step 1, step 2 filters, that's even better. Like, it's just like your water. Like, imagine having no filter and it's just coming from the city with like all the sewage and everything else coming. That's disgusting, right? Nobody wants no poo water on their dining room table. So what do? We add filters. And like, what do you do? Sometimes people add filters at their house. So then they have them on the sink. Then they have them in the refrigerator. It's all about like, what exactly do you want to get out of this? If you want just water, you need to have a lot of filters. And in this case, if you just want good stocks, you need to either have a lot of filters, you need to have pretty strict filters. Like, on Facebook, there's a bunch of different, I'm a really big presence, not big presence. I'm a bigger presence on Facebook than I am on like Twitter or X. So one of the groups, it's got like 70,000 members. It's called Dividend Growth Investing. And when I came up with my criteria, the one I discussed earlier, I put it on the Facebook page because I was like, if anybody can find a problem with something, it's on the internet, right? Like, somebody's going to find something wrong with it. So I was like, hey, use my criteria, filter for your stocks, and tell me what stock you find using this criteria that you would consider a quote unquote bad investment, poor idea, bad company. I had 2 responses. One response was, this one almost fits your criteria and I consider this a poor company. I'm like, well, that's not how Excel works. When I click the filter button and I say I don't want anything with less than a 10% dividend growth rate, it doesn't keep 9.97s in there because it's almost. It gets rid of those because it's not 10. So I was like, almost doesn't count. And then second of all, I wasn't getting there wasn't a response, which is really weird to me because, like I said, if I was looking for somebody to poo poo on something, the internet's where you go. So like, I didn't get anything, and that was my point. Is like, whether your filters are complex or simple, they need to be understandable and they need to be something that you can follow. Because if you can't follow your own filters, then they're useless, and if you can't understand your own filters, they're also useless. So like, I was like, okay, Joseph Carlson, another very big presence on YouTube, he and I get to the same end result with the stocks that we find. His filters are way more strict than mine as far as like, he's looking at this metric and that metric and all these numbers that I don't understand and all kinds of stuff. To me, that's a barrier to entry because somebody out there watching your channel or watching my channel might think, if I don't know what debt to free cash flow and this number and that ratio and this percentage means, I can't invest. I'm not ready. And that's not the case. So I was like, how can I break this down? It's simple. I can follow. It's easy for me to understand. And I can get to the same results that like other very good investors are getting to. And that's how I came up with my stuff. And like I said, it's, Facebook comment proofed, and it's, it's doing well for me. I think it could do better, but I'm not worried about this year or last year or next year. It's about 10 years from now. How does my portfolio perform?
Sure. So, Troy, if you were to start from scratch, I mean, just at this point in time, knowing everything that you know now, with about 4 years worth of the experience in investing and dividend investing and learning and growing as an investor, what would be the game-changing strategy that you would implement right from the get-go, or perhaps something that you would change? Just how would you start from scratch today to set yourself up for more success?
Yeah, I mean, I would have. So it applies to the broader audience. I don't have a YouTube channel in this case, because I'm not trying to entertain anybody. If I was just a regular Joe Schmo person and I'm just trying to be the best investor I can be, literally, I start with the ETFs. I build it. I'd probably say 10K total because I did have an interest in investing, so I'd want to get to it quicker. So I wouldn't do 10K each. I would do QQQM, VOO, build it to 10K total. I probably just do 50-50, just 5K in each of them. And then I would be very picky. Like I would be in no rush to add stocks. Like it would literally be like if I get to the end of my first year and say I'm able to save $12,000 my first year, 10,000 VOO QQQM. If I get to the end of the first year with 12K and I have 3 holdings, I'm okay with that. Like if I have VOO, QQQM, and Broadcom or Visa or something like that, and that's it. And I want to say I want to build everything to at least 5K before I invest in a new stock. Like I'd figure something out like that. And then it'd be like, okay, cool. All 3 of these are at 5K. Now I can at least entertain the idea of finding something new. And it would just be like, I don't know, maybe my goal would be to like add 1 stock a year. Like it does it can be an exclusive club. You don't need to invite everybody in. Like it's one of those things. Like the idea of adding a bunch of stocks, it spreads out, it casts a wider net, right? Like there's a bigger chance that you catch a winner, but there's also a just as big chance that just because you caught that winner, now your money is spread between so many stocks that it's not going to win by as much as it would have. Like you don't need to like be and the ETFs, in addition to like helping you understand the market and stuff, it also help make sure that you're diversified. So I don't need to be worried if my portfolio at the end of year one is VOO, QQQM, and Broadcom. Oh, I'm too heavy into Broadcom. It's 33% of my portfolio because I'm diversified with my ETFs anyway. So like you can really ease off the whole I'm not diversified stuff. You can ease off of that too and just relax, go into it, treat it like an exclusive club and just, really buy things that you're really convicted in. And if you can't find anything that you were like 100% sold on, maybe you increase it to $7,500 in your ETFs until you really find something that you really like, and then you can buy something else.
It's funny. That's actually almost spot on what I would actually do. Like if I had to start over, is take it a little bit slower on adding individual stocks, load up. I mean, I'm almost talking for myself personally, building up a position of like VOO to $100,000. Just like talk about a dynamite type of foundation. Now, my last guest left a question for you. So on Masters of the Market, what I'm going to do now is every time I'm going to ask a guest to leave the question for the next guest. So our last guest here left one for you. And the question comes down to, which we already got a little bit of an answer to, which what's your ideal dividend growth rate? But in that question, he also had, what is your ideal dividend yield and dividend growth rate and why? So we know that your dividend growth rate is 10%. Hit us with the ideal dividend yield for yourself.
I mean, the non-real answers, like if I could find a stock that has a 50% yield with a 50% dividend growth rate with a 5% payout ratio, that's the stock you're looking for, right? But and the weird thing about like the series that I put out on Fridays that I was talking about is people in the beginning, it used to be called the Power Five. So I was looking for the stock with the highest yield, the highest dividend growth rate, the longest dividend streak, all stuff like that. And what I was finding, people were in the comments saying that the stocks I'm mentioning don't have a high enough yield. I'm looking for stuff with 4, 6, 8%. And I was saying I'm not adding any filters that I'm not discussing. The filter I'm adding is, does it outperform the S&P 500? And truth of the matter is, when I add that filter, the stocks with the higher yields don't. Like there's very few. You might have like your ABRs, your IIPRs, stuff like that that might still outperform, which is they're the exception, not the rule. But once you add that filter, it's the stocks with the lower yields, stuff between like 2.5% yield and lower is typically your best performers. Like they perform well, and if you have a good dividend growth rate in there, like at that point you focus on yield on cost. I'm not really super concerned about my yield on cost yet because I still have 20 years to do stuff with it. But I don't know, to directly answer the question, like if I could find something that really outperforms the market under a 2.5% yield, like I don't love Nvidia style yields, like the 0.04% or whatever that is. Like that's a little hard to get motivated by, just because like that's basically just a growth stock that accidentally pays a dividend kind of thing. So I don't know, that would be my thing, somewhere between like 0.5% yield and 2.5% double digit growth rates. Like that's dividend growth rates. That's kind of my jam. That's like my sweet spot for my kind of stock.
I feel like this is almost a great segue for our last question here, and I almost know where it's going. in terms of an answer. But if I were to give you $10,000 right now to invest into one stock, which stock would it be and why?
It can't be an ETF, right?
It's your $10,000. Put it wherever.
What? You're so kind. I mean, in that case, like if I was starting all over, it would be that. It would be VOO, or I'd probably split it 5 and 5 into QQM and VOO. If I was being risky with that $10,000, because it wasn't my $10,000 to begin with, which isn't my style, I'd do a UPRO TQQQ kind of style, because those are triple leveraged, and I don't I don't know what the market's going to do next week, next month, next year, I actually don't really know what the market's going to do ever. But one thing I can say is that the market's never had a negative return over the last 30 years. Like a 30-year period, it's always been a positive return. It might not be a huge positive, but it's always been positive. That's why I like those stocks, like the UPRO in my HSA and my Roth. I can't access them for another 30 years anyway. So my thinking is I'm triple leveraged. There's actually stop limits or some kind of like mechanism in the stock market where it won't let the stock market drop in a certain percentage in a single day. So I'm kind of protected from that. I actually just learned that not too long ago. I think it's like 33% of the stock market drops in one day, the market actually closes. I didn't know that. Fun fact. So yeah, so there's some measures in place to help with that, but also like I have 30 years to let it go. I'm dollar cost averaging into those things. So as they go up, they go down. I think in 30 years, if the S&P 500 is up 3% in 30 years, which would be an awful return, I'm up 9%. So my return's a little less awful than your awful return is. So it's kind of one of those. So if I was risky with that, but with my current portfolio, if you gave me 10K, I couldn't invest in ETFs and I have to put in my current portfolio. I'm literally doing what I'm doing now. Like my stocks that are currently on punishment are still on punishment, and I'm just going to add 10K to my 17K, which gives me 27. And anything over 17, I literally divide it and I invest every day. I just literally, how many days are left in the or in the month? 8 days. Cool. I have this much money to invest over the next 8 days. Divide it by 8. Put it in every day. That's one of the things I do that I think is very useful for any of your subscribers too, is find ways to take the emotion out of it. And there's going to be days where the market, Apple go up 2%, down 2%, up 1%, whatever, all kinds of stuff. I don't look at it because I can't control it. So I just buy every day, whether it's up or down, it doesn't matter. I'm going to get the best price overall over the long period of time. Who cares? Like I don't worry about market price. I don't worry about none of that stuff. I can't control it. So I know I have whatever I have 31 share, almost 32 shares of Apple. I want a lot more than 32 shares. The only way I can do that's by buying Apple. So I just buy it.
A lot of wisdom coming out of the dividend obsession. Investors, if you have not been over to Troy's channel, it will be linked down there in the pinned comment. You have to go check out Troy's channel. Also has interviews over there and a lot of insights just coming out of the dividend obsession. So Troy, I want to say thank you so much for joining me on Masters of the Market. It's been a real honor, privilege, and pleasure. And until next time, investors, we will see you all there.